How much lower are markets going to head for Korea?
Good question. Overall, it comes down to how we deal with the debt resolution process, not just in the US and Europe, which is what's worrying the world right now. Overall, what we'd suggest is the market actually presents reasonable value. What we're looking to see, though, is a bottoming of leading indicators. Growth is decelerating, so from our perspective, we could quite easily see markets fall 5 to 10% below a 200-day moving average, and that not necessarily suggests a new bear market. That said, 200-day moving averages tends to be a point at which markets question themselves and look for a bounce, so a technical bounce here is entirely plausible.
Okay, well, I guess what I'm asking you is, at the end of this year, where are we going to see the Kospi sit?
Now, from our perspective, I think that you'll see the Kospi at similar levels to where we are or higher, and the only question will be how much lower we go to precipitate the action that will give us confidence. And that action is policy from either the Fed or the ECB, any sort of monetary action to suggest they're going to support markets. Because what we know is that fiscal policy is now constrained, and the markets on their own are having trouble generating organic growth.
Okay, well, we know that South Korea is a tech-heavy economy. Are you surprised by the underperformance of some of the tech names, considering we had this rally in technology on Wall Street in the U.S.?
No, it's not a major surprise, because we have to consider that what tech accounts for in Korea is different to what we see in the US. We're heavily oriented toward components in Korea, and so pricing cycles for things like panels and semiconductors are very different to what's going on at the end consumer level. So overall for Korea, the problem we've had is declining prices, and this has really hurt the stock performance.
Okay, well, where's the value then in South Korea, considering you do have the won at pretty strong levels still?
So actually, the tech sector is beginning to show values by virtue of the fact that it has gone down. So you do have some quality names that are getting quite well valued on a price-to-book basis, which means we can be less worried about PE multiples, in that through-the-cycle returns should justify purchasing those stocks. So we're actually incrementally positive in the tech space. We definitely like the internet space, because that throws off an enormous amount of cash, and the multiples are much more forgiving. The earnings growth is better, and they're much less macro-oriented.
Well, Shaun, I'm sure a lot of your clients are also asking about what's happening globally at this point with the sovereign debt crisis and the U.S. Let me ask you about the slowing economic growth. Are we in for a double dip? What are you telling clients right now about the U.S. economy?
It's actually too early to tell if we're in for a double dip, but certainly we have to be open-minded to the risk. We should acknowledge that equity markets, particularly in the developed world, are essentially in a secular bear market that peaked in 2000. And so up cycles tend to be shorter, lasting sort of 2 to 3 years rather than sort of 3 to 5 years. So we have to be resilient to that risk. But the signals are, while deteriorating, it's not definitive that we're headed into a bear market. So our view has been pretty clear with clients. You need to focus on high-quality companies with reasonable valuations, strong balance sheets, so that you can hedge the risk that we do deteriorate and head into a recession. But you don't want to be aggressively positioned for that now, because with the policy environment the way it is, you could have central banks punishing you for being too conservative.
All right, Shaun, thanks for sharing your thoughts this morning. Shaun Cochran, CLSA's head of Korea research.